Most business owners think retirement planning is just about stashing money away for the future, hoping for a tax deduction, and maybe getting a little employer match. But if you're a business owner, you're not just playing the employee game, you're the employer and the employee. That means you have access to a completely different set of rules and incentives that most people never even see. But here's the real risk. If you don't understand how the solo 401k works and you don't know about the new tax credits and deadlines, you're not just missing out on deductions. You're leaving free money on the table, giving up control over how you build wealth, and possibly setting yourself up for a nasty surprise at tax time because you missed a deadline or structured the plan the wrong way. And honestly, the confusion is normal. If you've ever tried setting up a retirement plan as a business owner, you know it's a maze: deadlines, contribution limits, Roth versus traditional, solo versus group plans. A million opinions online. Most CPAs and advisors don't even mention the solo 401k loophole, let alone explain how to actually use it properly. And if you're trying the do-it-yourself method with TurboTax or some robo-advisor, you'll probably miss the most valuable part entirely: the tax credit that literally pays you to set up your plan. Here's why people get this wrong. The rules changed, and almost nobody told you. The Secure Act quietly introduced a new tax credit for small business owners who set up a solo 401k with auto-enrollment. Most people assume auto-enrollment is only for big companies with lots of employees, but here's the twist. If you're a solo business owner, you are both the employer and the employee, which means you can auto-enroll yourself, claim the credit, and literally get paid to build your own wealth. Now, let's break down how powerful this really is. The solo 401k allows you to contribute as both the employee and the employer, which means you can put away significantly more money than most retirement plans allow. For 2026, you can contribute up to $24,500 as the employee if you're under age 50, plus up to 25% of your compensation as the employer. The maximum combined contribution, $72,000. And if you're over age 50, you can add another $8,000 as a catch-up contribution. If you're between ages 60 and 63, that enhanced catch-up jumps to $11,250. And here's the kicker. If you set up your solo 401k before December 31st, 2026, you can still make contributions all the way up until your tax filing deadline and deduct them on your 2026 return. But this is where it gets even better. Thanks to the Secure Act, if you add an auto-enrollment feature to your solo 401k, you get a $500 tax credit every year for 3 years. That's $1,500 in credits just for checking a box. And most business owners miss this completely because they assume tax credits are only for large corporations. But the law is clear. If you're the employer and the employee, you qualify. Now, here's why this matters financially. A deduction lowers your taxable income, but a tax credit, that's dollar for dollar savings. If you owe $5,000 in taxes, a $500 credit immediately drops that to $4,500. Real money, real savings, which means the government is literally helping pay for the setup of your retirement plan. Now, compare that to what most business owners do. They open a simplified employee pension IRA or a simple IRA because they think it's easier, but those plans have lower contribution limits, fewer investment options, and no setup tax credit. The solo 401k gives you bigger deductions, more flexibility, and more control. And if you're not using one, you're basically playing the game with one hand tied behind your back. And here's another mistake people make all the time. They wait. They say, I'll deal with this next year. Big mistake, because if you wait too long, you could lose the employee contribution window and the tax credit entirely. The IRS doesn't care about your intentions. They care about deadlines. And if you want the deduction plus the credit, you need to act before year end. Let me give you a quick real world example. Sarah runs a consulting business and made $150,000 this year. She sets up her solo 401k before December 31st, adds auto enrollment, and contributes $24,500. As a result, she gets a $24,500 deduction plus a $500 tax credit. And she can repeat that process for 3 years. That's $1,500 in credits alone, plus tens of thousands in deductions. Now compare that to John, who waits until January. He can still make employer contributions, but he misses the employee contribution window and loses the tax credit entirely. The cost, smaller deduction, and zero credit. But here's where this gets really interesting. The solo 401k isn't just about tax savings, it's about control. With a properly structured, self-directed solo 401k, you can invest in real estate, private businesses, crypto, gold, alternative assets, things most people never realize are even possible inside a retirement account. You decide where your money goes, not not Wall Street. And contrary to what most people believe, your money isn't completely locked up either. With a solo 401k, you can borrow up to $50,000 or 50% of your account balance, whichever is less, for virtually any reason without triggering taxes or penalties. And if your spouse works in the business, it gets even better. You can effectively double your household contributions because each spouse can contribute up to the maximum. That means dramatically larger deductions and dramatically faster wealth accumulation. Now let's talk about the biggest mistakes business owners make. Number 1, missing the setup deadline. Number 2, forgetting to file Form 8881 to actually claim the credit. No form, no money. Number 3, setting up the plan but never funding it. No contributions means no deductions. And if you own multiple businesses, you also need to coordinate your contributions carefully because the IRS limits your total contributions across all plans combined. Miss this, and you could accidentally overfund your accounts and create unnecessary compliance issues. So what should a smart business owner actually do? First, check your eligibility. If you have no full-time employees other than yourself and your spouse, you probably qualify. Second, set up the plan before year-end. Third, add auto-enrollment so you can claim the tax credit. Fourth, work with someone who actually understands the Secure Act rules. And finally, consider self-directing the plan so you have more investment flexibility and more control over how your money grows. Because at the end of the day, the solo 401k isn't just a retirement plan. It's a wealth-building engine. Used correctly, it gives you bigger deductions, more flexibility, more control, and tax credits that literally pay you to save. Used incorrectly or set up too late, it becomes just another missed opportunity. But here's the part most people miss. Even if you master the solo 401k, there's another trap waiting for business owners who incorrectly move money between entities, things like funding a new LLC, buying real estate, or investing in partnerships. The way you document those transfers can make or break your tax strategy, and most CPAs completely miss this. If you want to see how to avoid the intercompany transfer trap and make sure every dollar you move between your businesses is working for you instead of against you, click the video popping up on your screen right now. I'll show you the single most important step in documenting transfers, protecting your deductions, and building long-term wealth the right way.